Good afternoon, everyone. How are you doing? Welcome to Tuesday the 10th of August. I just want to check quickly if you can hear my voice and if you can see my screen. If you can do both, that's great. Well, I've just sent the strategy out to your inboxes. I know, Raj, you haven't got it. I'll send it again to you. But I hope the rest of you have received it. And it's a really interesting, well, I believe, report today, as there's such a confluence of factors affecting not just the E-mini S&P, but by de facto the euro and the oil markets and the bond markets, in fact, across all asset classes, as we look forward to the big statement tonight from the FOMC. Now, I've got my opinion on what's going to be said tonight, and it's against market consensus, but before I start on that, I'm going to talk about what happened yesterday. Here I've got the E-mini S&P 180-minute chart. Okay, 1 second, Victor. I'll see if I can put the volume up. I'll see if I can put the volume up on this one. Okay, so here I've got the E-mini S&P 180-minute chart, and last week, guys, I was talking to you guys about the range, okay, about this sideways red box that we've been in, and you can see that was really with a high just below that 1130 level, and the low really around the 1112 level. Okay, that's what we've been confined in, and this is where we find ourselves back. Okay, we did dip below it on the non-farm payrolls figure, obviously a massive disappointment on that figure, but I can just remove this rectangle, and now I'm going to extend that rectangle out. I'll just do it here. Okay, so there we are, guys, still well within this sideways pattern. Andy Mack was saying in the room earlier that really that we haven't seen, okay, we're only 10 days into August so far, but we haven't seen such a tight range like this for quite some time, and I think that signifies the level of uncertainty in the market, but also the lighter volumes in the market. No one really knows where this is going. So what happened last night? Why are we ticking off away from those highs today? Well, last night, China, bad data coming out of the Chinese market. In fact, it was down 2.9% as Chinese imports grew less than expected, and in fact, in some capacities, Chinese imports even fell. The reason why this is interesting is particular importance was given to the commodity level. The imports of Chinese commodities fell. And this is interesting, as even though imports from developed countries remain good, the level at which China imports commodities is seen as a leading indicator into how they see the exports of their goods, okay, in terms of balancing their books. It's a leading indicator in terms of how the Chinese see demand for their exported goods panning out in the future. So obviously by lower commodity imports, that signifies perhaps lower growth in the rest of the world. We also had UK data out later on, and that was UK sales. Now that's weakening also, so a bad picture coming out of the UK. There is still growth, however. The most notable fall was in TV sales based on the quarter before, stimulated by the World Cup obviously. Now people are finding better things to do with their time. They're finally getting outdoors. They're not buying houses, however. Report this morning of -8%. Weaker demand for houses. Appears with something on the market, as well as I actually, are saying tell me about it. And this is because housing supply has increased at the fastest pace for 3 years. Okay, so there's a lot of supply going on in the market in the UK. But that's by the by, not obviously so relevant to the S&P. We're still stuck within this range, guys. It's a very sideways moving market. There's no clear direction and no clear pattern, and it does make you need to adjust your trading strategy accordingly. So looking ahead, guys, what's it all about? It's all about the FOMC at 7:15. I'm against consensus here. That the market, especially looking at the level of government record lows in yields for government debt, bonds being pushed up across the board, the market is expecting some kind of statement changing what was said previously by Ben Bernanke in terms of his commitment to further quantitative easing. To me, this doesn't make too much sense. Okay, yes, the economy, you know, the speed of the recovery isn't as strong as perhaps many traders thought or many investors thought. There is a bit of a stumble in momentum, but it is still growing, and I think it would be it would be foolish for Bernanke and co to react to short-term investor sentiment in terms of panic over the lack of growth. You can see we're still relatively high in the E-mini S&P. We've still had a good few weeks growth going into August. I don't think the Fed should, and I don't think the Fed do actually care about the short-term market optimism being slightly dented on the back of these negative macroeconomic figures. Therefore, I think they'll keep the strategy consistent with a moderate pace of recovery going forward. Things, after all, could be a lot worse, guys. I think, in my opinion, the market's perhaps expecting too much, and at 7:15 you might see the market being disappointed. And the reason why this is interesting is if you have a look at the euro and in fact oil, there's a confluence of factors affecting the euro dollar, and that's reflected in our morning report for today. Obviously, after the non-farm payrolls, you had a spike lower in the dollar as money moved into the euro, and we hit those highs of 1.3333. Okay, since then, as concerns over global growth have come into the water, there's been a flight to quality trade back into the dollar. Now, why are we long for the euro dollar? Why do we think this might go higher? Well, for two reasons, for example. If then these concerns are on the lower world economic growth and that the Fed therefore will commit to some kind of quantitative easing statement, that is negative for the dollar. Okay, in terms of long-term interest rates, that's negative for the dollar, and money should move back into the euro. It's a very strange pattern in the euro dollar, and that sell-off yesterday was quite hard to understand, really. Perhaps it's because of the concerns on China, perhaps it's because of the lower Chinese rate, but you know, we must stress that there's a confluence of factors affecting this currency pair, which is why we're neutral with an entry long. It's not clear if the Fed is going to make a decision on stimulus tonight. The only thing that will put money away from the dollar is if they don't commit to any type of QE strategy, then I think stocks will be disappointed, and sharply disappointed, and I think money will move out of the euro back into the dollar. It's a real mess the day ahead in the euro dollar, so if you are going to get involved in this currency pair, don't marry any positions, stay reactive to what's going on. The market will tell you what it's looking at, whether it's looking at fears of global growth or whether it's looking at quantitative easing language coming from Ben Bernanke. What else has happened so far? Well, we've had Irish spreads widening to 2-week high this morning. As you remember from yesterday, they stuck out like a sore thumb in terms of European consumer confidence data. Added to that today, they disappointed on Irish industrial production figures, coming in at 1.3 against 1.75. You're right, Danny, the rate cannot go below zero. Let's have a look at oil. What are we expecting for the oil market? Well, obviously, again, the main factor affecting the oil market will be tonight's FOMC. You can see the reaction in oil yesterday to the grind higher in stocks as the market expected QE packages this evening, and I believe, as I said, the market expecting it incorrectly. Since then, oil's come off based on obviously the negative Chinese data coming out for commodity imports, but also for concerns over growth. I think, guys, as it turns out that Ben Bernanke will not be changing his statement and stocks do get a hit, I can see us very definitely testing the $80 handle, and in fact it was just above that where we've got our level of support at $80.04. You can see that from the 6th, that was non-farm Friday, the low set then, and we've just moved just above it. We were ideally looking for an entry short this morning at 81.33, we've moved below that now. But should we move below the $80 handle and then the 76, 79, 69, there's quite there's some blue sky really coming back into the market, and we can have some quite aggressive moves in oil, I believe, so that's going to be an important one to watch. However, again, a confluence of factors affecting this commodity, because if, for example, no QE package is mentioned, you'll get the dollar strengthening, you know, but stocks will be disappointed. How's that going to affect oil? Is it going to react to the stocks? If something is mentioned, if there is a QE package mentioned and stocks like it but the dollar weakens, how is that going to affect oil? Obviously it's going to be a tug-of-war situation there on that commodity. So really it's quite a murky picture, and I think we can't really say with confidence how these asset classes are going to be affected, but without doubt, one thing is certain. Tonight's 7:15 conference is going to be absolutely fascinating. I'm putting my eggs in the basket that he's not going to commit to any further measures. He doesn't need to. The recovery is continuing. It's just not as good as the most aggressive traders and investors would have liked. I don't think he needs to commit to further QE, not yet anyway. I think the market will be disappointed on that, so I think you'll see some good action. If nothing happens before then, perhaps the first opportunity will be on the cash market open. We've got a few minor figures